Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to another week of market action. Of course, you're listening to The Real Investment Show, and it is, of course, Monday as we get things underway. Starting this week, we're about to kick off Q4 earnings season. We'll get some of the major banks later this week, and then next week we'll really start to get into most of the major corporations reporting their earnings. So we'll have lots to talk about here over the course of the next few weeks anyway. Right now, buybacks, kind of on hold at the moment in the blackout window. Those will start to come back as soon as companies start to announce. So starting really kind of next week, buybacks will slowly start to open back up by the end of the month. We'll have a good bit of action in terms of corporate buybacks helping support markets, etc. This morning, let me back up. On Friday, markets set a new high. This morning, markets are going to be a bit lower this morning. The big news over the weekend, of course, is that Jerome Powell, the Department of Justice, is considering filing an indictment, I guess, or charges, etc., considering against Jerome Powell over this building of this new, or actually the remodeling of the Federal Reserve building. If you'll remember a while back, the President Trump went and visited the new kind of renovation of these offices. They're running about $2.5 billion to refurbish these offices, which was, a lot for just a refurbishment. And there was a lot of debate back and forth about, the cost of this building and what's, just the refurbing of the building. When JP Morgan built an entire tower for about the same amount in New York City, they're just refurbing a building. So there was a lot of discussion between President Trump and Jerome Powell over this. Some accusations were made about cost overruns, etc. So anyway, that's what the Department of Justice is considering kind of filing charges on right now. Against Jerome Powell. Now, the media is immediately interpreting this as this is basically the president trying to gain influence over Fed policy. Maybe it is, maybe it isn't. There's been bad blood between these two for a long time. So, whatever the real motivation is, the market doesn't like it this morning because, well, what the market wants is an independent Fed. They don't want outside influence to influence the decisions the Feds make on monetary policy. And that's, look, there's always been influence by policy over the Fed. That's not a new thing. The Federal Reserve tends to go along with what administrations want historically. But what they don't want is direct kind of visual influence, right? And that's what this appears to be at the moment. And again, whether you agree with it or not, it's irrelevant. The market doesn't like it this morning. Futures are going to be down about 200 points on the NASDAQ, about 50 points on the S&P. So again, we're going to have a little bit of volatility, at least right out of the gate this morning. The volatility index is picking up here a bit. We'll get into the technical wrap here in just a minute. But looking forward into earnings, Q4 earnings are very optimistic, but 2026 has really gotten very optimistic. We've now ramped up over the course of just the last really kind of month or so. There's been a big increase in expected earnings for 2026, and I've got an article out this morning kind of going through that and what the risks are relative to where those earnings are derived from the underlying economy. But Wall Street analysts are very, very optimistic right now about 2026 earnings. 2024 earnings for Q4, however, have already been revised down about $10. So we've reduced earnings estimates every quarter over the last year from the original thought of what they were going to be versus what they turned out to be. Those are down about $10 in general for the Q4. We'll see how earnings come in, but that does lower the bar enough for, again, another very good beat rate for earnings season. We'll probably have 75 to 77% beat rate, which is about average of what we get every quarter. The big thing to be looking for from the banks in particular will be kind of the future of kind of interest rates and collateral requirements for the banks, kind of what's happening economically with their loan cycle. Their outlook's going to be much more important than what they actually report in terms of earnings. And then over the course of the 2 weeks after this, we're going to get into all of the kind of the big mega cap companies, Apple, Microsoft, Meta, and then we'll get a better view about what's going to happen with AI. CapEx spending this year is going to be a big question. Is that increasing? Is it decreasing? Potential volatility in those stocks because of what their outlook is. Again, what they report is going to be much less important than what the outlook actually is for those companies over the course of the next couple of weeks. So again, I would brace a little bit here for some volatility in the market, which brings us to what you need to know before the bell this morning. Markets did set a new high on Friday, getting a little bit overbought here. So again, this kind of news over the weekend, as we've talked about before, the thing that gets the market is something unexpected. This was unexpected, right? Now, is it a major thing? Probably not. This probably all gets resolved and goes away pretty quickly, and something, some negotiation comes out of this, and this all goes away. But that's going to lead to short-term volatility. Again, markets weren't expecting that. That's what kind of brings sellers into the markets, particularly when you're sitting at fairly high levels and a bit overbought. Again, deviation from the 50-day moving average is getting pretty large. So again, that's that kind of gravitational pull of price should not be unexpected. That's when we talk about managing risk, taking profits, rebalancing, those type of things. So when these things occur, they don't have a really big impact to your overall portfolio. But overall, the market's in a good position. A couple of things to be just kind of thinking about here over the next 2 weeks is because of earnings season, there is going to be a potential pickup in volatility, particularly in some of the areas of the markets that have been a little bit more stable lately. That's not uncommon. Again, we had kind of a weak start to the year in terms of the Santa Claus rally filling. The first 5 days were a little bit positive, but again, that typically suggests volatility in the last half of January and first part of February. So again, a little bit of pickup in volatility would not be a surprise here. So this is really kind of a good opportunity to kind of look at your portfolio and kind of just rebalance some risk and kind of move some positioning around just a bit to help hedge that volatility risk. Because again, if you take a look at volatility, it's been very, very suppressed, and we're actually starting to see a bit of a tick up. Volatility has been creeping up here very slowly over the last really kind of week or so heading into this announcement. Again, volatility is still very compressed here, but we're going to get a little bit of a push up today of volatility because of what's happening in the markets. But again, we're pretty low levels. We're on a buy signal, which suggests you could see a further rise in volatility over the next week or so. Doesn't mean that has to happen, so don't immediately go sell everything. This is just one of those things you just kind of pay attention to, because again, from very, very compressed levels, you can get one of these spikes in the market that occurs. And again, those are short-lived typically. Kind of just a reset of markets down to support levels, and again, kind of go back to the S&P. We've got immediate support levels sitting right here at the 20-day moving average. We're going to be pushing, kind of testing on that a little bit today. That's at 6850, 6800's the 50-day moving average, and then we've got the 100-day at 6690. So there is some downside risk, 2-3%. And these tests of these supports are not uncommon. So again, when you have very low volatility tends to beget high volatility, and when you have these kind of deviations from means, that's where you're going to get that pickup. And all you need is some type of catalyst to help move that needle into the sell category, and that's kind of what we're seeing happen over the weekends. Now, if there's any follow-through from this, I don't really think so. I don't think this is the big mover for the markets. I think earnings are going to be much more important. So again, over the next couple of weeks, I think that's where your risk picks up here a bit. Anyway, that's what you need to know before the bell this morning. And when we come back from the break, we'll kind of talk a little bit about the lessons that we should have learned in 2025, and also talk a little bit about quarter four earnings for 2026. So we'll kind of get into both those stories this morning. More of the Real Investment Show coming right up. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
right, welcome back to the show this morning. So again, kind of a couple of things to kind of get into this morning. I wanted to talk a little bit about the investor lessons that we should have learned. Real quick, if you haven't gotten your ticket yet for the summit, it's this weekend. It's this coming Saturday. So again, it's going to be really good. We've got a few seats left. So just simply go by the website, realinvestmentadvice.com. Link right at the top of the page to get your tickets. You can get that ticket and come over. Friday night, we've got a mixer that it's kind of a limited person event. I think there may be 1 or 2 tickets left for that. If you want to come to the mixer, just going to stand around, we got heavy hors d'oeuvres and just kind of visiting with each of the speakers and asking questions. It should be a really nice time. And then on Saturday, we have the actual full event. So there's 2 different tickets, one for one for just the event on Saturday, one for the mixer and the night before and the event. But those are on the website. So simply just go. You can get the one ticket or just the combo, whatever you want, at the website realinvestmentadvice.com. Anyway, it'll be a lot of fun. Hope to see you there. I'm going to be talking about specifically this view of economic reflation in 2026. It is now the prevailing idea for why we're going to have a massive surge in earnings this year. As this economic reflation. And so I'll be going all through that and what the risks are, presenting both kind of the bull and bear case. So I've been working on that. It's actually turned out pretty well, I think. So I think it'll be a good presentation. Anyway, so lessons that we should have learned in 2026. This is kind of the outlook that we never really pay much attention to. We always kind of go from year to year. It's like, what did I do in last year? What did the market do? What did I do? And the thing is with that, it's fine, except it leads us into repeating mistakes. And what I mean by that is that when you think about investing in particular, we spend more time worrying about what's happened in our rearview mirror than what we should be paying attention to and the things to be thinking about ahead. So we think more in the past than we start thinking about the future, even though what we tell ourselves is that we're thinking about the future, right? This asset class did really good last year, so I'm going to own it this year because it did really good and I didn't own it last year, so I'm going to own it this year so it'll keep doing well, or vice versa. That asset class I owned didn't do well, so I'm getting rid of that and I'm going to buy what worked well last year. And see, that's kind of managing your portfolio from kind of hindsight. And that doesn't work out well because over time, what did work in the past won't work in the future because things change. The markets are dynamic. People are arbitraging the markets, they're hedging the markets. So what did work will become a loser in the future, and what wasn't working will become the winner in the future. And that happens all the time. And one of the biggest reasons why investors underperform over the long term is because they're constantly chasing what happened last year. So what's important to think about more than returns is to think about, okay, what did I do last year that worked? What happened last year that didn't work? And what should I be thinking about for this year? And that's why, again, a lot of the work that we do here is analyzing narratives and analyzing kind of mainstream thought, because groupthink, when you have everybody thinking the same thing about something, that's the thing that tends not to work or to become the case. So this is kind of the jux of this weekend's newsletter. So if you haven't subscribed to the Bull Bear Report, I suggest you go by the website, realinvestmentadvice.com, and just scroll down a little bit on the page, and there's subscription buttons for our weekly newsletter, our daily market commentaries, our weekly blogs. We put a lot of information out to help you manage your portfolio better. And one thing I've been trying to do more and more of as of late is to include investment tips in each of the articles. So again, here's the article. This is the analysis. Here's kind of some tips to navigate what that suggests. So I'm trying to give you more of these kind of usable tactics to, help you manage your own portfolio better. So anyway, this weekend's newsletter went through kind of these investor lessons that, again, as we look back, always try to look back to last year and say, hey, what worked, what didn't work. One of them was this idea, and kind of the number one lesson is to leave narratives behind. right? When there's a lot of narratives in the markets or for whatever reason, leave those behind. And because generally those narratives never turn out to be right. Early last year, I wrote a couple of articles because there were numerous people, Paul Tudor Jones, Stanley Druckenmiller, others that were coming out going, oh, don't want to own bonds in your portfolio. They're interest rates are going to 6% or 8% or 10%, and the debts and the deficits. It's the end of the fiat currency world, blah, blah, blah. And we warned you then, is like, be careful of those narratives because those typically tend not, those end of the world doomsday type scenarios tend not to work out well. And last year was a really good year for bonds. In fact, on average, about every maturity of bonds returned a positive return last year. And bonds also provided a very good hedge against the volatility that we saw during the 2025 downturn, during that April Liberation Day event. So bonds did their job of providing volatility. They also provided about a 7% total return last year across the spectrum of bond holdings. So again, be careful with narratives because narratives will typically tend to push you into a direction that you don't want to be because narratives very rarely turn out to be true. Just remember this one thing. At the end of the day, the only thing that moves price is the amount of buyers versus the amount of sellers. That's it. Narratives don't move price. Narratives are the rationalization for buyers or sellers, right? I'm buying this because I heard this in the media, or I'm selling this because I heard this in the media. Narratives are not analysis. Those are emotional biases that are impeding into your investment process. What you need to focus on is the actual analysis, the fundamentals, the drivers. And do those fundamentals or drivers actually have teeth? And that's why we spend a lot of time in our blogs and our newsletters breaking down these narratives and saying, look, this narrative is fine, but the economic data doesn't support that, or the factual data doesn't support that. There was a lot of comments last year about de-dollarization and the end of fiat currencies, and the data does not support that at all. On any level does that support it. So again, it's a good narrative, makes for great headlines, great for clicks and views, but the data doesn't support it. So that will impede your returns in the future. Maybe last year it worked for you, that's fine, but it's unlikely that will work for you in the future. So be careful. So one of the major lessons last year was to just kind of leave narratives in the rearview mirror and look at what is actually driving markets. Another good lesson last year was and we learned this really in kind of late March, early April, is that volatility is not the same thing as risk. And that's often a miscalibrated measure by investors, and they assume that volatility is risk. But risk and volatility are different things. Volatility is just movement of price. I can have low volatility where markets are just moving up and down a little bit every day. I can have high volatility like we saw in March and April where markets declined 20% over the course of a month. That's not fun, but it happens. But that's not risk because, again, risk is a function of capital loss. Risk is kind of the easiest measure of understanding what risk is gambling. Everybody understands gambling pretty well. And if you're sitting at a poker table with a pair of twos and you're looking at the other hands that are being bet and how these other people are betting their hands, you can pretty much quickly process your odds of winning in that particular hand, right? And odds are what we're talking about. When we're talking about risk, we're talking about the odds of loss. That's all risk is. It's the odds of capital loss in your portfolio, destruction of capital. So if you're betting, if you're playing a friendly game of poker with your friends and you've got $100 on the table and you bet it all on your hand, your risk is pretty much binary. Either you're going to win the hand or you're going to lose. There's no in between. You don't get half your money back on a bet, right? You either win or you lose it all. And that is the pure definition of risk. Now, that's not the same as volatility. Volatility is just price moving up and down. Risk is the permanent impairment of capital through a bad decision. And so last year was a really good example of this. We had high volatility through Liberation Day. And, we had a lot of clients call us up and say, get us out of the market. And we're like, okay, if that's what you want, we'll get you out of the markets. And immediately the market bottomed. We were buying, assets right near that bottom. And because that was a short-term volatility event and that was going to pass. So you can take advantage of volatility to your, for your portfolio, take advantage of these drawdowns when they occur if you can process through what that means for risk. Again, I can have a high volatility environment. That doesn't necessarily mean I'm going to have a permanent impairment of capital. And so that's one of the lessons to really learn from last year is that falling prey to volatility, that's a choice. Understanding risk is a decision you need to make. And they're not necessarily joined. Another good lesson last year was that cash has value. We've written about this before, talking about cash. And one of the pushbacks I always get, I see two mistakes that occur with cash. The first is the pushback I'd normally get is like, but I've got money sitting over here in cash and it's losing value to inflation. No, it's not. Inflation erodes value over very long time frames, not in the short term. And particularly when, you can put money into a money market account that's yielding 3 or 4%, you're not losing money to inflation. What people assume that is that, oh, I'm losing value because the market's going up and I've got this cash sitting there and it needs to be making more money. And we all kind of get tied up into this greed factor. But cash has value. On a short-term basis, cash has a lot of value. It provides a hedge for volatility and it gives you optionality. I can't buy something cheap if I don't have any money to buy it with. Right. And this is one of the always the kind of the interesting comments made by, the mainstream media and a lot of these people that are buy and hold. It's like, oh, just buy and hold an index. It's fine. It'll just go up over time. It's true. But then they'll turn right around and say, it's like, oh, you need to buy stuff cheap. Well, I can't buy stuff cheap because you told me to buy and hold everything. So now I've got everything I've got. It's invested into the markets and I'm buying and holding. I'm riding this market up and down. And so when there's an opportunity to buy something cheap, I don't have any money to buy it with because I never sold anything. I never took profits. I never rebalanced my portfolio. I never did any of the normal processes that allowed me to accumulate some cash to buy things with when they're cheaper. If you really want to win the game long term, you can dollar cost average into an ETF and you'll be fine, right? You lump sum invest, you'll way outperform the dollar cost averager over time. In other words, accumulate cash when markets have a decline, you put a lump sum in rather than dollar cost averaging every couple of weeks. You'll win, when you lump sum that invest and buy larger chunks at lower prices, you're going to win over the long term as the markets do rise. But, when we talk about cash, we're not talking also about being 100% in cash. This is another mistake that investors make. It's like, the markets are going down. I need to be all out of the markets. That's fine when markets are declining, but it's very, very tough to get back in. Think back to April. Markets are down 20%. There was a lot of panic in the markets. People didn't know what was going to happen with tariffs and what this all meant. We had all these articles coming out from the mainstream media saying, oh, this, tariffs are going to, cause the next recession. They're going to cause a depression. And we're saying it's like, that's not really the way they work, but, more power to you. And of course, it didn't turn out that way. So people that went all the cash was fine, but it took them a long time to get back into the markets because they were like, well, everybody's saying that the markets are going to crash because of tariffs, right? And so this is one of the things that is important to learn is not to go to extremes, either in either direction. Don't be all in on everything or don't be all out of everything. There's some moderation in between. What cash gives you is they give you that optionality to navigate risk, that permanent impairment of capital. Now, again, I'm not talking about holding cash for 40 years, right? When cash does not erode to inflation over a month or 2 or 3 or 4 or 5 or 6, right? While you're holding cash waiting for an opportunity. Yes, over many years, cash will lose value to inflation. That's the purchasing power that people always like, oh, the dollar's down 90% in purchasing power. Yes, because of inflation over the last 100 years, because we've had economic growth. So yes, a dollar sitting in a jar has lost value, has lost purchasing power if you did not invest it. So, but that doesn't happen over the course of 6 months. Another lesson is that, and we're going to learn this one again, is that earnings drive long-term returns. And it seems evident, but this is one of those that we typically forget. And we start focusing on all these other issues. And we've talked about this a lot here on the show, is that when you start seeing these headlines about, the coming crash, markets will be down 50%, those type of things. Yeah, that's probably going to occur at some point. But that's not just because that's not because of the debt or the deficits or anything like that, because that's all well known by the markets. The markets already know all that, and they've priced that into the markets. If you're worried about the debt or the deficit or the dollar, go pay attention to the markets, because the markets have already priced those risks in. What the markets haven't priced in is something that occurs that impacts future earnings growth. So here's a chart of the annual rate of change in the S&P and the annual rate of change in forward EPS. And you'll see there's a fairly high correlation. Right now, forward earnings estimates, year-over-year rate of change is rising, so has been the markets. Not surprising. If something occurs that causes a sudden, unexpected change into those forward estimates, in other words, those forward estimates drop sharply, the market is going to reprice for lower earnings. And that happens, right? Since 1999, since the turn of the century, we've had five basic periods in that period where we had negative earnings growth. And then we go through a period of expansion. Then we have negative earnings growth for one reason or the other, right? We have a slowdown, whatever it is. And so that's going to happen again. Could happen this year. Don't know. Something could happen. But generally, this is something that is credit related or something that is fundamentally related. In other words, a good example would be is this coming next couple of weeks. Every major mega cap company comes out and says, yeah, we're not going to be investing that much in CapEx and AI. We just determined it's not worth it. That market is not expecting that. That will cause a very rapid shift to the earnings outlook for these companies, which was, since those 7-10 companies make up the bulk of earnings growth expectations this year, that's going to be a problem for the markets. That's what causes big reversions in the price of the market. So again, pay attention to the earnings. Forget everything else. All these other narratives don't matter, because the market already knows about those. What you're looking for is the event that the market was not expecting. Again, we talked about this last week. The Liberation Day, President Trump, everybody was going into the Rose Garden announcement on tariffs expecting 10 to 15%, and he holds up this board with 30, 40, 50% on it. Markets completely freaked out over that because you had to completely reprice earnings for much higher tariffs and the impact on profit margins. That's what you're looking for, that type of event. That's the one that says, okay, I need to really de-risk my portfolio right now and really make a decision to go in some other direction because of this. most of these other mainstream narratives and YouTube channels and all this stuff, they're just regurgitating talking points that have no real value to you other than stirring up your emotional biases, because the markets have already priced all that in. Another lesson was that your plan needs to, whatever your plan is, however you're invested, however you build your allocation, that's fine. There's nothing wrong with that. The only thing that you need to be aware of is that your plan has to be able to survive stress. And again, we kind of go back to that March, April timeframe, Liberation Day sell-off. How did you do? Think back how you felt. Think about how you performed. Think about what you did. If you did good things, right? You weathered through it and you bought the dip and got great. Your plan worked. That's good. If you panicked and sold out and fell kind of prey to the stress, okay, let's go learn from that lesson. The market bailed you out, which was good, right? We had this big 35% rally from the lows, so the market bailed you out. But whatever plan you have, it needs to have survived stress. And this is the one thing I get a lot of emails from people thinking about. They go, I've got this new idea for managing my portfolio. What do you think? And I'm like, I back tested this and it works. Back tests never work in reality. So you can back test a portfolio to the nth level of extremes, and then you put real money in it and it falls apart. Happens all the time because environments change, and back tests are based on certain variables. Right, so I'm going to run a back test that says every time the market dips below the 200-day moving average, I'm going to buy stock. I'm just picking one, right? So I'm going to buy stocks. Well, again, the market already knows that, and so hedge funds, arbitrageurs, all those type of people, they're aware those strategies exist, and they're arbitraging those strategies. So those strategies that you back test become less effective in the future because the market adapts to them. And so this is why whatever plan you use, whatever structure, whatever your process is, make sure that it can survive stress. This is why we spend a lot of time on the show with you guys talking about risk balancing, portfolio position sizing. I wrote that whole article recently about portfolio management sizing. Those types of actions will help whatever plan you have survive stress. So when markets get really overbought, that's why we talk about, hey, market's really overbought, they're extended here, take some profits, rebalance your portfolio. When things are really oversold, hey, market's really oversold, think about adding to your portfolio, those type of actions. That's how you navigate stress and keep from making these decisions that lead to a permanent impairment of capital, because that, as we said before, is what risk is. Stress is volatility. Stress is emotional impact from volatility. Risk is the permanent loss of capital. That's what we want to avoid. Because again, if you make a decision or you have a strategy that winds up wiping out all of your capital, it was a really great example of this just over December. I'll tell you about it. But if you lose all your capital, it's a problem. Let me read to you this from this was from the Wall Street Journal talking about stress and risk management. And this was very interesting. If you watch the series Landman, they actually just used this idea of how to gamble on Landman. So the wife of Billy Bob Thornton goes to Las Vegas, and she took all these people from the old folks home to Vegas to go gamble, and which is pretty funny. But some of the guys from the old folks home were sitting at the roulette table, and this is called the martingale system. And they were betting on specific numbers, like, 7 red, 8 black, whatever. And they were losing their money that they had to gamble with. And so Angela, the wife of Billy Bob Thornton, walks over and she says, "You don't understand what you're doing. You only bet red or black. You only bet red or black. You don't bet numbers. You just bet red or black." And the dealer's like going, "That's not the way this works." She goes, "Oh yeah, watch me." And so she bets on red to start with, and she bets like $1,000, and she loses. So next she goes, "Leave it." Bet on red again, $2,000. She lost again. $4,000. She loses again. She's betting red every single time. $16,000, $8,000, $16,000, $32,000, and she hits. And then she lets it ride, and she hits again. And she lets it ride, she hits again. She lets it ride, she hits again. And so she waited for, so what the martingale system does is it tells you you double your bet every time you lose until you win. And that's what this is the reason I tell you this little story, is that because this actually happened just this past December. There was a option trading group it was led by this guy named Captain Condor. And it's a trading system. So, okay. So the options trader, I'm just going to read this to you from the Wall Street Journal. The option trader known as Captain Condor and his acolytes experienced a wipeout last week that incinerated $50 million and cost some investors their life savings. A strategy that had reliably produced winnings for the trader, whose real name is David Chow, and his group of roughly 1,000 investors went awry just before Christmas, saddling them with what was, by one count, a $50 million loss. The fatal flaw, what finally caused Chow and his crew to lose most or all of their trading capital, was his use of the martingale betting system, which we were just talking about. In the system, the bettor doubles down after each loss, hoping to recoup their money and then some. After a streak of mounting losses, Chow and his followers risked it all on Christmas Eve and saw the last of their capital wiped out as the S&P index tallied a record closing high. They were betting on the markets declining. Some of the members of Chow groups lost hundreds of thousands of dollars, most of their life savings, and according to account statements reviewed by MarketWatch, one member launched a GoFundMe page soliciting donations to help cover basic living expenses. The point is, whatever system you use, you cannot have a complete wipeout of investment capital. You lose all your capital, you're out of the game. So whatever system you use has to have risk management processes in place. See, that is the definition of risk. That is permanent impairment of capital. That was pure risk betting. That was the same as Angela going to the roulette table and just doubling down every hand until she eventually won on the roulette table. The odds were actually better in roulette than they were in the markets. But that's the lesson to take away from that. And again, this is where things like another good lesson is that rebalancing works, right? If you had rebalanced your portfolio in February and March when we rebalanced ours, then when you had that April drawdown, yeah, it hurt. The market was down 20%. Our portfolios were down 3 or 4% during that time frame. So yeah, you took some impairment, but the rebalancing process kept you from losing a lot more capital. And this is when we talk about rebalancing, keeping a watch on growth versus value, momentum versus fundamentals, those type of things, because when the market rotates on a consistent basis, and so understanding these rotations and how they work can help you limit your volatility risk as markets go through cycles. Kind of the last lesson was just thinking ahead. Again, we spend too much time looking behind us about what worked last year. Oh, that worked really well last year, and I didn't own that, so I'm going to buy that now. If it already worked, you're on the wrong side of that trade. We need to start thinking ahead. What's going to be the next cycle in the markets? Where are markets going to move to next? Because markets, again, always remember that markets are just a big group of buyers and sellers. And in the middle of a move, the herd is generally right? Because everybody's kind of piling into the same trades, whatever they are, AI, whatever it is. So in the middle of the move, everybody's on those same trades. And so everybody's making money because you've got lots of buyers coming in and you've got fewer sellers because nobody wants to sell. So the more buyers that come in and you have fewer sellers, that drives the price up and it all works. But at the tail extremes, either on the upside or the downside, the herd's always wrong. And so this is why you want to start thinking ahead, is looking at deviations from long-term extremes, those type of things, because at those extremes, that's where your imbalance of buyers and sellers will start to show up. And that's what leads to bigger corrections in price one way or the other, either to the downside or to the upside occur, because the markets are going to start looking for those opportunities. where money has left, where there's opportunity, and then that's where the professional investors start going in. They start building positions. They start promoting those type of things through Wall Street. Man, Wall Street's a massive marketing machine. So the traders at JP Morgan see an opportunity in large cap value, whatever it is, and then they start promoting that. It's like, oh, value's coming back. And so that starts dragging, and they're already invested. They've already made that investment. Then they start promoting it, dragging more of their clients in, more of the media in, and then that starts driving more buyers into the value trade. The value trade starts to gain traction. That attracts more people in, so forth and so on. But this is why professional managers make money a lot. And you take a look at JP Morgan, like JP Morgan's about to announce earnings later this week. Every single quarter, a big chunk of their revenue comes from where? Their prop trading desk. They make money every quarter because they can control markets. They have that ability to move markets in their favor. So think ahead. Think about where, as Wayne Gretzky once said, he's like, I don't think about where the puck was. I'm thinking about where the puck's going. And that's what you need to do within your portfolio as well, is think about, okay, this is what worked last year. Let's think ahead about where that puck's going this year. Right now, a big thesis is economic reflation. Wall Street is heavily pushing this economic reflation story, so don't dismiss it because they're positioning for it. And what does that mean for assets, and what assets will perform the best in that economic reflation story if they're right? All right, so that covers that. That whole article is in the newsletter this weekend. So if you are interested in kind of reading through that in more detail, it's there for you. One other thing is, I want to touch on this, and we'll probably get into this. I'm running a little bit short on time this morning, so we'll get into this a little bit more tomorrow. But just want to show you this one chart. This is the earnings estimates right now for S&P. And hold on, it jumped on me. Okay, so this is the kind of expectation for earnings this year. The blue line is the Magnificent Seven earnings per share, and the white line is everybody else in the S&P 500. And yes, earnings expectations are coming up for the bottom 493, but it is not necessarily the the level of earnings growth that we need to kind of support things. And this is what we see, the same thing in the revision in earnings expectations. Expectations for the Mag 7 for earnings has ramped up sharply over the last month or so. And we've now gone from a negative EPS revision in the bottom 493 to barely positive. So again, we're looking forward to a earnings season, and the earnings this next year are all functionally driven by an expectation that earnings are going to be rising sharply across the board for most companies. But when we get into what actually drives the earnings growth, and really we start talking about the things that matter, which is valuations, again, the big question we have to look at is what these earnings growth estimates say and what potentially changes that, particularly when valuations are very elevated. And when you take a look, this was a survey that was out by the Wall Street Journal a while back, and they surveyed all these Wall Street analysts, and they said, how important are your earnings outlooks? They are the most to your compensation, how they're compensated. Their earnings accuracy is the least important thing to their compensation. What's important to their compensation, this is why earnings estimates are always high, is that if I'm doing investment banking for Apple, I don't want to come out and say, oh, Apple stock is a sell. That's why there's never any sell ratings on companies by Wall Street analysts for the most part, because they're doing business with these companies. If I rate the company a sell, that puts pressure on the stock price, that impacts the executive's compensation. They don't want to do business with you anymore. They'll go find a different investment banking firm that'll give them a good rating and help bring their stock price up, right? So this is the game. So the accuracy of these estimates, these earnings estimates, are not important. So this is why, but the thing we've got to pay attention to, and this is the only chart that really matters, is that there is a very high correlation between economic growth and earnings. And what we're betting on this year, and if it comes to fruition, that's fine because we'll have some good earnings growth this year for companies, is that the economy hangs in there. So if the economy grows at 2.5% to 2.7% this year, you're going to have some decent earnings growth. If we grow at 2.2% or 2% this year, that's potentially going to be a bit of a problem for current earnings estimates. So those estimates are going to have to get revised down. And this revision lower in earnings happens constantly. We just talked about Q4 earnings have been reduced by $10 a share going into the quarter. So again, as we start thinking about this year, the current estimates are going to be revised lower this year. The trick is how fast are they lowered and what causes that lower revision. If it's just a gradual lower revision over time and everything is fine, markets will hang in there. If there's a rapid reversion in those earnings for whatever reason, that's going to be the risk. And when you take a look at corporate profits as a percentage of real GDP, we are trading at an exceptionally high level relative to the long-term trend growth. In other words, profit margins are trading at an extreme level. That is very, very hard to maintain. We've had these periods where profit margins trade well above the trend line previously, and then we reverse. So again, trying to maintain margins at these levels and improve those margins is going to become more challenging for companies. Now, AI may do that. AI may allow us to lay off a bunch of people and improve profit margins. Improving profit margins is great for companies, great for earnings, those type of things. Not great for employees. If you need a job, that may be a problem. But that level of profit margin is going to be tougher to maintain, and this is particularly the case if you take a look at non-financial corporate profits as a percentage of GDP versus GDP. That gap between profits and GDP is very, very hard to control. And normally you'll see profits catch down to GDP growth, not vice versa. So we'll see what happens. But again, I just think that's one of the risks. And again, we're going to get into earnings over the next couple of weeks, and we'll talk more about this. That article is on the website right now if you want to read through it this morning. I've also got some tactics in there about how to navigate this earnings season as well. That's on the website, realinvestmentadvice.com. But anyway, that kind of wraps up the show this morning. Tomorrow, we're going to get into Two Dads on Money with John Penn, talking about the perils of home buying and some other topics as well in the morning. So that'll be in tomorrow's show. So tune in then. Thanks a lot for joining the show today. I appreciate it very much. Be sure and get by the website, realinvestmentadvice.com, and get your ticket for the upcoming events this Saturday. Love to see you there. We can hang out, talk, visit a bit. Looking forward to it. All right, have a great day. See you back here tomorrow. Be sure to like and subscribe to the channel. Helps us a lot. We appreciate it. See you tomorrow.